Millions of highly intelligent people lose massive amounts of money every single year. Doctors, engineers, and executives watch their portfolios dramatically underperform the broader market. Even though they have off-the-charts IQs and possess incredible analytical skills. So why do the smartest people in the room consistently make the absolute worst financial decisions? Picture a normal Saturday night at a high-end dinner party. You are standing in the kitchen talking to a highly successful surgeon. They work 80 hours a week and make a massive income. You ask them how they are investing their wealth. If they told you they just put a few $1,000s a month into a basic, boring index fund, they would feel ordinary. It feels entirely too simple for someone with their intellect. So instead, they lean in closely and tell you about an exclusive private real estate syndication or a complex hedge fund that requires $1 million minimum deposit. They smile. They feel elite. They feel like they have unlocked a secret door. But a brilliant, entirely invisible trap has just been executed right in front of you. We are taught from childhood that extraordinary results require extraordinary complexity. If you want to solve a difficult math problem, you need a complex formula. If you want to cure a disease, you need a complex molecule. So, highly intelligent people naturally assume that building wealth must require a highly complex, incredibly sophisticated strategy. But they harbor the arrogant belief that a simple, boring financial plan cannot possibly yield extraordinary returns. This is a psychological flaw known as complexity bias, and it is the silent killer of compounding. When you prioritize the feeling of sophistication over the basic math of compounding, you aren't being a financial genius. You are paying a massive ego tax. You think you are outsmarting the market, but actually you are walking directly into a trap designed specifically for smart people. But the real reason they do this is much stranger. It is not about mathematics, it is about human psychology. Most people think the financial industry makes money by being better at predicting the future. They assume wealth managers are paid millions because they possess a secret formula. But Wall Street does not sell performance. They sell the illusion of complexity. Think about a basic index fund. It tracks the 500 largest companies in the country. It is entirely automated. It costs almost nothing to run. But because it costs almost nothing, the financial industry cannot charge you a massive fee to manage it. So how does a major Wall Street firm justify charging you 2% of your total wealth every single year? They have to make the investment look incredibly difficult to understand. They invent complex derivatives, layered debt tranches, and exclusive private offerings. They put a velvet rope in front of the product and tell you that you are one of the few people smart enough to get inside. Most people disagree about this. If you read financial forums, people fiercely defend their expensive wealth managers. They argue that paying high fees is the only way to protect their money during a severe economic downturn. Some economists argue the exact opposite. They point to decades of obsolete data proving that highly paid, sophisticated hedge fund managers routinely lose to completely passive, unmanaged index funds over a long enough timeline. Here's where people are split. Is financial complexity a necessary shield, or is it just a highly sophisticated scam? People don't make bad money decisions. They respond to the environment around them, and the environment of the wealthy is perfectly calibrated to stroke their ego. When a smart person buys a complex investment, they are not actually buying a mathematical advantage. They are buying an emotion. They are buying the ability to sit at that dinner party and say, "I have a guy." They are paying a premium for the privilege of feeling smarter than the average retail investor. Now look at this exact same transaction from the perspective of the financial institutions. To the massive firm, your ego is their greatest asset. They know that if they present a simple, boring path to wealth, you will walk away. You will think it is beneath you. You will assume it is a strategy for beginners. So, they wrap a basic asset in a dense legal structure, slap a massive management fee on it, and call it an exclusive opportunity. They do not buy mega yachts because their complex investments perform better. They buy mega yachts because highly intelligent people willingly hand over their capital just to feel special. Let's slowly reveal the invisible forces holding this entire machine together. The incentives of the financial industry require them to manufacture complexity. If investing was universally understood to be simple, the entire wealth management industry would collapse overnight. Their business model relies entirely on you feeling confused. The structures of society link your self-worth to your perceived level of sophistication. The social pressures among high earners demand that they do things differently than the working class. If the working class buys index funds, the elite feel a deep, unspoken pressure to buy private equity just to maintain their social hierarchy. And the probabilities dictate a ruthless, undeniable truth. Over a 20-year period, more than 90% of actively managed, highly complex funds will mathematically underperform a simple, boring market average. The people who lose massive amounts of money to high-fee hedge funds and complex syndications are not stupid. They are following the system perfectly. They are doing exactly what the financial industry trained them to do. They are prioritizing exclusivity over mathematics. They are acting exactly how intelligent humans are biologically wired to act when they are placed in a room full of their peers. The biggest financial advantage isn't intelligence, it's which game you're playing. The highly intelligent doctor is playing a game of ego. They are trying to prove their genius by outsmarting a market that cannot reliably be outsmarted. They are actively destroying their own net worth just to feel elite. But the truly wealthy play a completely different game. They play the game of humility. Wealth is often less about effort and more about position. If you position your portfolio to feed your ego, your returns will be constantly drained by fees, underperformance, and hidden risks. Your desire to be special becomes the exact leak that sinks your ship. But if you position yourself with humility, the entire power dynamic flips. You step completely out of the velvet rope illusion. You capture the raw, uninterrupted growth of human progress without paying a massive toll to the gatekeepers. When you finally understand this, the entire illusion of Wall Street shatters. You stop associating complexity with profit. You realize that true financial genius is not about finding a secret strategy. It is not about gaining access to a closed-door meeting or deciphering an unreadable spreadsheet. It is about having the emotional discipline to do the simple thing over and over again for decades. It is recognizing that your ego is the single most expensive thing you will ever own. In a financial world utterly obsessed with looking smart, feeling elite, and projecting sophistication, the absolute most profitable thing you can possibly be is boring.